What if the Iran-Israel war in 2025 wasn't a war at all, but a $14 billion trade setup? 3 nations, 4 decades of hate, missiles, drones, stealth bombers, and it's all over in 2 weeks? In the chaos, oil hit $81, then tanked below 67. Billions moved and no borders changed. Ask yourself, was this conflict or choreography? It started on June 13, 2025. Israel bombed Iran's nuclear sites at Natanz and Fordow. Precision hits that had been threatened for years. Then came the follow-up. The U.S. joined in. B-2 stealth bombers flew across the Middle East, dropping over 420,000 pounds of explosives in a single coordinated strike. Iran struck back. Drones, missiles, and a direct hit on a U.S. base in Qatar. On paper, this looked like the beginning of a regional war. But behind the headlines, the markets were already moving. Oil surged to over $81 per barrel, the highest spike since the Ukraine invasion. Major trading desks went into frenzy. Goldman Sachs, JPMorgan, and Barclays all issued warnings. If the Strait of Hormuz is closed, oil could breach $110. And traders listened. Billions flowed into long oil contracts. Everyone betting on escalation. But then came the twist. By June 24th, just 11 days later, the war was over. A ceasefire, no invasion, no regime collapse, no Hormuz blockade. And the market, it flipped like a rigged roulette wheel. Oil collapsed from $81 to $67 in days. A 17% swing that wiped out millions of leveraged positions overnight. Who lost? Pension funds, index trackers, retail traders who bought the fear, they got cleaned out. Who won? Hedge funds who shorted the top, firms who knew chaos wouldn't last, the traders who bet on a war that wouldn't escalate. But if you followed the timing, the quotes, and the volume, it's clear someone knew when to get out. When money moves fast, banks like JPMorgan get paid more through trading fees, volume, and volatility itself. And here's what the numbers tell us. JPMorgan's trading division made 15% more than usual that quarter, raking in nearly $9 billion. That's not from interest rates or new customers. That's from chaos. Oil spikes, market swings, and investors flooding in trying to time the war. And while markets flipped, the cost on the ground kept rising. The U.S. spent over $100 million on one night of airstrikes alone. 2 B-2 bombers, each carrying $30 million worth of bunker busters, $3 million in fuel just to fly round trip. That's enough to cover a full year's rent for 30,000 American families, vaporized in one bombing run. And for what? No regime change, no peace deal, just a spike in oil, a bloodbath in the markets, and silence. Over 900 Iranians dead, dozens more in Israel, and Wall Street moved on. Because that's what it was, not war. Just a profitable window of volatility, weaponized uncertainty. This isn't new. We saw it in the Gulf, in Libya, in Ukraine. The weapons change, the trades stay the same. So ask yourself, how does a war between enemies of 40 years end in 11 days, right after oil peaks? If the goal was peace, it failed. If the goal was chaos, it ended too fast. But if the goal was profit, it worked. MoneyLeaks. We ask what the headlines won't. We audit the battlefield.